And Bill, feels like there's a lot of uncertainty, and yet it also feels as we're at a stage in the market where there's willingness to pull back, but investors come right back in. In other words, there's a kind of a buying on the dip mentality, although we're off the very highs here. Characterize what you think is going on out there.
Well, we did have that nice little correction, healthy correction from the record highs after that really just melt up. And the S&P hit 10% exactly yesterday, and for a lot of people, that was enough to see. And right in front of there, I had a big technical level. I was looking at about 3250 in the S&P, and we didn't close below that, so it was pretty constructive overall. What the market, we could see this volatility. I mean, the election's not far away. What is it, less than 45 days or so now, or less than 2 months. But once we get through there, I think whoever wins, the market is going to take the fact that there's now more certainty, and we would imagine more certainty, and use that to its advantage. So I do think these pullbacks are pretty good buying opportunities. On a worst case scenario, we were looking at the S&P, and it still can. S&P down at 3,000, 3,050 area. But overall, these pullbacks, I think long-term are buying opportunities. The Fed's going to stay there. One of the things that stood out to me last week was the Fed really did provide a baseline to what they would need to see in order to then hike rates, because this whole QE to infinity was the narrative for so long, and they said maximum employment and symmetrical inflation above 2%. So now we have a baseline. They removed the QE to infinity, and we're seeing a little bit of correction.
Just give me a sense of which stocks you're watching, because it sounds as though you kind of called we're going to have a slight correction, and now you're feeling a little bit more comfortable with some of the valuations. Where in particular would you like to be right now?
I love software. I think, looking out 5 to 10 years, I trade the futures, and I do that as a more of a shorter term outlook. Where's the next 3%? But on the portfolio side, when we get into stocks, I trade those less. And I look out farther, and I think software is a great place to be 5 to 10 years out. And inflation's what's on everybody's minds right now. And I think if inflation shows up, we're going to start seeing that in the enterprise software. I think that those are well positioned long term to see continued advances in technology that's going to really carry them later on. Broadly, I've been looking at the IGV index, but I love names like Microsoft, Adobe, Intuit, CRM, Salesforce. All those I think are really great places to have in your portfolio. You need those in your portfolio. Microsoft gets a lot of the attention, but a lot of the others really should too.
And how do you feel about some of the big leaders on the way up here, not just Microsoft, but I would include Apple in that list? What's your feeling on how much of a pullback Apple's had versus it maybe being a little bit overbought?
I mean, what did it correct? 25% or so from its high peak. I think that's a great buying opportunity. Working with clients and for myself, buying Apple over the past week and just looking at that as an opportunity. Historically, we've seen that split, and if these large stocks, these behemoth, if you will, stocks, when they split, there is a year out, they average a 33% gain, and I think we can look at that being a ballpark gain for Apple over the next year. I think the market overall is going to get through this election and do well. So I like Apple. You need it in your portfolio, and if you don't have it in your portfolio, you're likely going to underperform.
And what else would you put in that category? Because there is, you get on both sides, you get the kind of FOMO of I wish I'd bought these things a year earlier, and then you get the kind of, they've got a lot of downside potential. What else is on the list of things that, though they may be volatile, you think you have to own here?
Well, what I just mentioned a little bit ago is CRM is the ticker, Salesforce. I like Salesforce. They had the gap up after earnings right around the time that they were being put into the Dow. 220 is a huge level. It's now closed right before there. So there's a big gap there. I mean, I think if you have an opportunity to buy Salesforce at 220, you look out a year to 5 years, you're going to be very, very happy. I think Salesforce is going to continue to be a leader. Even if the economy struggles, I think Salesforce isn't going anywhere. These companies are going to need their CRM. Whoever is still in business. I mean, in the bigger companies, they're not going anywhere. Some of these small companies, obviously, you hear about how the economy has pushed out these small companies, given lockdowns and stuff. But I think Salesforce is tremendous, and it's going to be the place to be. So if you have an opportunity to buy Salesforce anywhere, I mean, here's a great spot. I was buying some this morning and yesterday, but 220 is really the downside area to look at. I think it's a tremendous buy.
But I should ask you the disclosure question here, just in terms of some of the names you've mentioned, what you own and what you don't.
Yeah, I own all the names I mentioned. Salesforce, Apple, okay. Microsoft, Adobe, Intuit. Yeah.
So that's an easy one. What are sectors that you would avoid here, given the amount of uncertainty we still have about economic recovery? I mean, it'd be tempting to say we should go for, the growth cyclicals or at the beginning of economic recovery, but we don't actually know that because of COVID-19.
Well, one space that I'm going to flip with, I think fairly soon is energy. I thought last week from a trading perspective, as I mentioned, I use futures on more of a trading perspective, and positioned short in crude oil with some put spreads into that rally late last week. And I think as the market comes in, we're sort of on near yesterday's low right now on crude, but I think we're going to find some value long-term on the energy sector. And, I'm not a huge buyer at the moment. I want to see things lower. I think places like Chevron and some of the midstream energy is in a good spot with really high dividends. So as you're planning out, I think Chevron's somewhere in the 6-7% ballpark right now. The stock a lot lower than here, 10% lower. That dividend is going to balloon up a bit. So I think look for energy to be a great area to buy for the long term, a bit lower than this. And what? One thing I'll add too is semiconductors have been just a tremendous headline driver and have been great. One thing I would just keep an ear to the ground on over the coming months is what China is doing with their semiconductor space. They're investing a lot of money domestically there, and I wonder if that takes any air out of the balloon within the U.S. space. So I'm although I like it, I'm a bit more cautious there.
Well, I do want to ask you, because we've got this kind of, I don't want to call it a war of words, but certainly a public disagreement between Jay Powell and James Bullard about how much more fiscal stimulus is needed. What do you think we get, and how much does that matter to what happens to U.S. stocks? Well,
yesterday, there's a lot of reasons, and we talk about, in my morning notes, the market does what it wants, when it wants. It focuses on the headlines when it's ready to focus on those headlines. And the market was already vulnerable finishing last week. The quadruple witching added a little bit of unwind to it. And that was one of the reasons why we were bearish through September. But we look into the market being vulnerable coming into this week, and Ruth Bader Ginsburg passing over the weekend really just pits Washington, the both sides of the aisle against each other, and they're not going to get anything done fiscally, and that is one of the reasons why the market was lower yesterday. So if you look at that, they need to do something, but the market is preparing itself not to see anything ahead of the election. And that's one of the reasons why we may not recover so quickly, and we could shop around and see a lot more volatility for the next month and a half.